Welcome back to Capital Academy. Capital Academy is all about helping early stage and startup companies understand the space that they're walking into as they're looking for other people money. As you're looking for investors to invest in your project and your venture, there is a level of understanding you need to have on how to actually engage with them. And so on today's segment, we have an investor, we have Hilton Augustine, and we have an entrepreneur looking to raise capital. We have Pierre Walters. And a quick backstory is a training program that Pierre is walking through, and I've learned not to say training program. It's a educational enhancement process that we are working through. We covered CapTables, and I know from working with entrepreneurs that CapTables can be very intimidating for a lot of entrepreneurs, but you need to understand them in order to walk through. So today's session is to talk about CapTables and for you to hear both sides of that equation. So Hilton, can we start by if you would just give us a little information on you, your background, and what you do?
Okay, so I've been investing in startup companies at the seed level for about 5 years now. And my background is electrical engineer and did a professional career with IBM, but I started a company about 30 years ago now that did IT services and telecommunication services to the federal government. About 5 years ago, I sold the commercial part of the company and used that funding to now fund the angel investing. So this is something that gave me an opportunity to get out of an operational role and really get more involved in companies like I prefer, which is technology and things like that, that I'm well beyond my prime in creating. But I love being around it and encouraging others to do it and benefit from it financially.
Wonderful, and I think everybody heard, as an angel investor, it's you've been in business, so you understand business, and now you're utilizing your resources to help others.
Exactly.
Thank you so much. And Pierre, if you can just give us a little bit of background on you, who you are, and what you're doing.
Certainly. So my name is Pierre Walters, and I'm the senior producer and director of a creative agency called Blue Artists. And Blue Artists is focused on helping small business owners to build their brand and to do it by establishing their difference in the marketplace. And what makes us different, I think, from other creative agencies or marketing agencies is that we focus on a membership approach, which allows our clients the ability to have access to really high-level marketing services for just a membership. And so we kind of look at it like Netflix. Like we're like a Netflix for small business owners when it comes to building their brand and establishing their marketing presence.
Wonderful. And you're also now looking to grow your business beyond where it is, i.e. the reason that
That's right.
this has even come about.
That's right. And you know what, Lorette, I'm totally okay with calling it a training program.
Not self-enhancement.
Because, you know, I think that training, first of all, education is good. And I think, you know, I know what I'm good at, but I do need to be trained to understand what an investor is looking for.
Right.
I can't just, what I've found is that I cannot just, you know, say, hey, give me money. This is what I want to do, you know? Like it really helps to understand the mindset from the other side of the table. And that's something that I think you have to be trained to understand. So I appreciate it. Yeah.
So I thank you for saying that as the trainer. But I was corrected the other day. That's why I'm trying to work with this whole self-enhancement, you know, part of the story. So thank you so much. And to begin this, what happened in our session, we were going over CapTables. And just a short story behind CapTables, they are sort of the foundation of the ownership of the company, you know, how many shares are out there and who owns them. But they also provide the entrepreneur with an opportunity to see what long range their capital raising could look like as they're considering giving up some of the equity in that company. So I'd like to start from an angel investor side of the table. How do you view cap tables? What are you looking for? What do they mean for you? Can you speak to us about, again, what you're looking for when you're viewing a company's cap table? You know what? I'm sorry. Let me start from most of the early stage of startup companies you speak to, do they even know that they need to have a cap table and what it is?
Correct. I'm glad you brought it up first.
Okay.
Because again, coming from friends and family, and from the day you start your company, you own 100%. And whatever number of shares that is, or whatever par value, you have that little piece of paper that says it, and that's what makes everybody proud. I own 100% is my company.
Yes.
So when you get to the point where you're asking for money and you're trading off equity, the first thing I like to have people understand is the cap table really is an extension of your accounting. But not as a second problem. Most people don't do any accounting in their companies up to this point.
Right,
So it's just take people's money, spend it, and they
Right.
really don't track that. So it's not a habit that they're in the habit of, performing on a regular basis.
Okay.
So first we got to get them to understand the accounting of their business. And then the cap table becomes an extension of that to the point that this is the capital of the company. This is what the company really is on paper.
Right.
So once we get that understanding, that's the beginning. That's why we have to send them here, right? To say, okay, now that you know that training, now that you know that, and you have to account for it, then the next step for me is you have to project that thing just like you project the financials of the company going forward, because everything morphs along with the changing and the finances of the market, the value of the company, and the ownership changes. So you need to be able to project that out in the future as well, because as an early investor, I not only I'm concerned about my position in that stack, if you will look at it that way, I'm concerned about my position all the way along the way. And if this is going to have an exit that's going to make me money, I got to know that that exists and that you and I realistically understand what that looks like. So that's just my overview to say, I look at it as an extension of accounting that has to be carried forward and projected and have a pro rata version of that to show me what my return is down the road.
We spoke earlier about what you send entrepreneurs for them to complete when you're considering them.
Right.
Is a cap table a part of that? Is there
Absolutely.
information? Okay.
As a matter of fact, I almost say the main part. I'd almost say the main part, because for me, again, how much I invest may be irrelevant on the cap table.
Gotcha. Point well taken.
Well, and I don't know to the extent we want to get into terms of dilution and all that kind of stuff. We may get into that later, but yeah, the terms upon which I invest my money is very important, how that fits into the cap table.
So what we just went through this week, in hearing him say that, what are your thoughts? Does that jive with everything we were able to take a look at in going through the cap table?
Yeah, I would say it definitely does. One of the things I really appreciate about the cap table was being able to see what as an owner, what actually is my equity value, what is my stake in this business, and being able to sort of set that and be comfortable with that before moving forward. I know that without, and by the way, like, once the cap table is complete and looking at that from a bird's eye view and being able to see, okay, I really am comfortable with my stake in this business and also the stake of my other founders or my other operational leads, it really helps me feel at ease with bringing in, or more like inviting in someone else or a group of other people who would like to purchase equity. I think that without the cap table, that was probably one of my biggest apprehensions, was just not understanding or really feeling comfortable with how much am I giving up to get how much back, and not really. And I joked around in one of our classes with, actually I guess it was the specific class with Lorette, where I was saying, is there an algorithm for this? Because I love algorithms. So if I can see, like, okay, input this much, get this much, like if I can see that, it just makes me feel so much better. So this, to me, I think would be like the closest thing to that. I know it's not completely automatic, and I know that it's kind of, it's flexible and fluid. But just being able to see it in the same way that I would look at our finances for our business in terms of where we want to go, and if we have this many clients, how much are we making, what's our expenses, et cetera, is just really helpful and really empowering.
And let me interject, that's a great point you make, because as an entrepreneur, if you see the whole picture up front it really does become algebra, because here's the total picture. And if we can agree on, I got this much stock and that's it, and whatever the value of the company is that you project 5 years out, where you may be expecting exit or sale or going public or anything like that, and then you work backwards from there to say, when we're 5 years out, where do I want to be? Do I want to be a 30% owner, a 20% owner, a 50% owner?
Right.
Of course, most owners want to be a 95% owner. But again, without the help and the investments, that 95% may be 95% of 1 million
Exactly.
versus 50% of 50 million.
Exactly.
And that's a totally different way to look at it. So if entrepreneurs would look at it just like you said, now I understand the whole picture. Now I understand what portion I want, because I see where and again, if it's realistic and we all agree this is the end point and it will be worth such and such here, then you can be comfortable making sure that as I go down in actual percentage ownership, I'm still happy with the share that I'm going to get out of this thing.
Right.
And that's what scares most entrepreneurs, because when we start talking about our ownership position, and you hear the worst of it on Shark Tank, you come in saying I want to give up 10% and they say I want 50. It's like, they're not ready to handle that at this point.
Yeah.
But if they can extrapolate and say, yeah, but I'll be doing 50% of 50 million
That's exactly
versus my 90% of 10.
Right.
It makes it a different way to look at it, as long as you have a grasp on it as an entrepreneur.
Right.
So you made a lot of great points.
Thank you. And I also think that, I guess one more thing on that is that being able to see that big picture really helps me as an entrepreneur feel like, you know what, this is bigger than me.
Right.
And look at all of the moving parts. Look at, okay, I can sort of rest assured that that I've started something that's fantastic, but look at where this goes without me. And so when it does come to that point where I want to exit, I can feel really good about some, like, my little ding in the universe.
Right.
That I've done something fantastic but other people are now involved, and it's larger than I could have ever imagined.
Right.
Yeah.
That's, like you said, 50% of 50 million as opposed to 95% of 1 million.
Right.
Like, seeing it that way just really goes, okay, right. It's good to have people involved.
Right. Absolutely.
Something that Lorette said in one of our classes was, sure, you can cash flow everything, but you're gonna get to wouldn't you get to your destination faster if you had more hands on deck and more capital on
Right.
deck? I mean, isn't that the truth?
Yep.
And that was something that, for me, was also sort of a light switch moment, because I had sort of reconciled myself that, as a business, we're going to cash flow everything. I mean, because I couldn't see I couldn't see outside of myself like that. And I felt comfortable with our revenue, and just knowing that the stuff that we want to achieve, we can. But now I'm looking at it and saying, well, think bigger, Pierre, because you can. And there are people who would love to get on that ship and think big with you.
And that becomes one of the growth strategies as well. It's sort of like the franchise idea. If you've created a model that works, and the next step is going national with that, it takes capital, especially if it's reproducible and you really can duplicate that process. But again, as entrepreneurs, we tend to think in terms of that marginal growth that I can do versus if I had the wealth of everybody else and the strategic partnerships that go along with some of those investments.
And I think that's a sheer nature of them understanding. When you don't have an understanding of what an investor can bring to the table, because a lot of entrepreneurs think an investor is only their money. Right. And the other line that you wind up hearing is, but I don't want them telling me what to do. You laughing, right? And that's not what real investing is all about. And I will tell a client in a minute, when you're looking for an investor, you look for an investor that works for you. Every check is not the check that you want.
Exactly.
The same way an investor is reviewing you, you should be reviewing them, because it has to be, especially an early stage seed. If you're a public company, you don't have to be concerned about who the investors are, unless they have such a
bigger share,
exactly, that they're
control
in
something.
the meetings. But number one, for entrepreneurs to understand that an investor should be looked at as a strategic partner, no different than any of those joint ventures or anything else you bring to the table.
Absolutely.
But once they start, one of the first questions I do get, or comments I get, is not wanting to give up equity. I want money, but I don't want to give it. Okay, that's a little bit of a problem, right?
Absolutely.
And so going through, one of the reasons I like to do the training programs is I have the best client when they understand what we're
Right.
walking into.
Exactly.
When they don't understand and I'm constantly explaining, that's a little bit of an issue because my voice shouldn't be the voice that you're making decisions off of, right?
Right.
You should be making decisions because now you got it, and I'm now just a sounding board that we can sort of strategize off of,
Right.
And so the cap table was big for me because I knew it laid out that this is what you have, this is where you want to be, but what are those steps in between? Because you raise capital in stages.
Right.
You don't step in to raise everything that you need from the beginning.
Exactly.
I have someone who's talked to me about $24 million that they want to raise. I'm like, okay, what are the stages? And I got to look like, what are you talking about? I need $24 million. Okay. Right?
Stage 1.
So it's a startup company, hasn't done a penny in revenue.
And by the way, for that money, I'll give you 2% of the company. Right?
So anyway.
Wow.
But, you know, for companies to see the stages in the cap table, it is just huge for them. And I got to tell you, Pierre, and there's another gentleman in the class, Glenn, just watching how you guys' eyes lit up when you got it.
Yeah.
Because then the next step is going through valuations.
Right. Exactly.
But are there any war stories that you could share with us
Yes, there are.
as it relates to getting through that cap table discussion, that quote, basically valuation discussion?
Right. So there are steps that even as an entrepreneur, you learn as you go. And so now, along with the template I have for companies that I do due diligence on, I personally have some things that I always like to see in the cap table and clauses in our final agreement that protect me.
Okay.
And there are things like anti-dilution clauses.
Yes.
Sometimes it's appropriate, sometimes it's not.
Okay.
Depending on what stage you invest in. Sometimes, again, I don't mind being diluted if there's going to be a huge pie based on this next investor
Can
coming
I
in.
just say that I actually know what you're talking about? I just, like, this is good.
Right.
Dilution, I got that.
Exactly.
I know what you're talking about. Awesome.
And for those who don't,
Join the training class.
exactly. But there are some cases where I know in a company say whatever my investment is 5%. I'm happy with that all the way to the end. And I don't mind. But if I'm going to dilute with the original owners, that's fine too. But I have to know, and I have to make sure the clauses represent that.
Okay.
So there was a story around that issue that, you know, again, initial investors got diluted so much, it was so little, and, you know, while it was a positive exit, it wasn't as good as we thought it could have been.
Right.
And as you get larger investors in, the terms change, and, you know,
Right.
so we have to put in protections for us that at least protect our investment at that early stage of risk, because there's a lot of risk. So I call anybody who follows me from an investment standpoint, I call them greater fool than I. So yeah, we're all kind of, you have to be a little crazy to
Right.
invest anyway.
Right.
Yeah.
But it sort of helps me reassure my decision that somebody else took a look at it and said it was worth it, and at a higher valuation than I came in at.
Right.
And then of course, if it's followed up by venture capital or any other kind of money or going public, then that again helps me say, you did make a good decision, at least one that other people agree on at another level at a higher valuation.
There's one point I want to make with that, and then a question I want to ask. So the point I guess I want to make is the same way we talk about entrepreneurs needing to be trained to understand a lot of this, angel investors start from not really knowing about investing also.
Exactly.
So there are mistakes that an angel makes in the beginning.
All
and
kinds of them. Yeah, lots of mistakes.
Right.
So it is a learning process as well, even
Right.
if you have legal help and accounting help and things like that, because it's more strategic.
Right.
You have to think about strategically, and every company you do due diligence on, it's a different kind of risk.
Right.
And it's a different level of risk, and there's different protections you want to build in for that kind of company.
And one of the things I do speak to angel investors about is, what is your thesis? What's your investment thesis, right? It's one thing to be investing in companies, but it's another thing, the same way we're talking to an entrepreneur about the cap table and where it takes you,
Right.
an investor's thesis should be similar, that it gives you a roadmap for how you're actually going to invest your money.
Right.
Because otherwise, investors don't always have a limited,
Exactly.
unlimited amount of funds.
Well,
Right.
your example about the $24 million request. So a couple of lessons I learned along the way is when an entrepreneur has a defined round of money they're raising, they know how much and they know when they want to close it, because it's important to say, I need this much money in this time. And their plan should follow what that means. Why is that money there? That's always the question.
Right.
It's marketing, it's development, it's whatever, but it's a planned period of time. So I used to invest in the company based on all the criteria I set and say, okay, good, I'm in, and I put the money in. But if they don't raise the entire fund or the money they're trying to raise in that period of time, then they're off plan already, and my money's already in.
Wow.
Yeah.
Okay.
So now I try to put in a commitment that's contingent on you raising the entire fund, so that
Gotcha.
we know we have the funding to complete the task that we outlined.
Right.
And you're not underfunded, and then my money was just thrown away.
So that would
that's-
be like a letter of intent.
Well,
I mean,
yeah.
actually,
Well,
in,
it's
in
less
my
formal
world,
than that.
in
Yeah,
film,
yeah, it's less formal than that. It's just a
Okay.
commitment.
Okay.
And some companies, when they pitch to me, they'll say, "I'm raising 500,000. We soft circled 300,000." That's one of the terms they use to say we got those commitments, so we're trying to raise another 2. And so now I'm one of those that would be soft circled and saying, I'm committed, but only if you get everything.
Right.
And that's one lesson I learned. The other is, again, that 24 million. So how are you going to spend the money? You're not going to spend 24 million at a time. You're going to
Exactly.
spend, some of it
Right.
this month, next month, and let's see that
Right.
plan. And maybe I might want to have a contingency that says as well, I'm going to give it to you along that line.
Right.
So I'm only at risk by this amount of money for that
Right.
period, and then the next money. And so this is another way to minimize my risk, yet give you what you need. Not just that 24 million. You don't need 24 million. You need this amount every month, and so it's contingent on successfully meeting those requirements.
that makes a lot of sense.
Yeah.
Yeah.
I mean, it really does make
Yeah.
a lot of sense.
When you put my shoes on, you see it,
Yeah.
you see it differently, right?
I like to work through the scenario of a raise in 12 to 18 months. So when I say stages, I tend to think that that's how you look at the capital you need to raise
Right.
in a 12 to 18 month period of time. Does that stand for an angel investor? Does that make sense for how you look at companies? Or do you look at it with different time periods, if any?
That absolutely works.
Okay.
Because even from an exit horizon, we're 5 to 7 years.
Gotcha.
And understanding that throughout that period, you morph in several ways, and actually those stages help quantify and legitimize the plans you put together. So if we're looking at, so when you make that first round of money, you say I'm raising $500,000, one of the terms we use again is runway. So how much runway
Yep.
does that give you?
Yep.
And that's important to know. I'll last another year with this amount of money. And what's that milestone after the year, other than just calendar year? We get to profitability, or we get the product developed, or we get to expand in this market. So
Right.
it's got to be concrete as to what my money is doing for you in this period of time. And then if we get there, then it's, again, another raise, whether it's from current investors or new investors, based on some new milestones
Right.
that we can measure along the way.
Right.
So those are very important
Okay.
points that you bring up that help me quantify and ration it out to reduce my risk along the way.
It sounds to me like as you go into the consecutive rounds that, well, it sounds like the investment become, or it's, I don't want to say easier, but less, maybe I should say less risky, because if it's a new investor, they can see, okay, the company has reached these milestones. They have made good on what their plan was with the first round of investment.
Right.
And so, because one thing that you were saying earlier is that you like to sort of vet your choices based off of your peers, some of your other investor, I was going to say
Glad
collaborators.
you brought that up. That's
Yeah,
what I wanted to say before,
associates,
yeah.
and to help you feel good about the decision that you're making. So an investor coming in at a consecutive round, like if you were that investor, you would feel better. You would look at how that company has performed in that first round and say, yeah, okay, based off that, I'm more likely to want to participate in
Right.
this next round. Is that?
That's absolutely on point. And to that point, as an investor, if you already have a round, you normally advertise that in the next round as well.
Absolutely.
Here are the people who invested this first round, especially if they're well-known, investment firms or angel groups or VCs or anything. That becomes part of your pitch to say, these guys have already done due diligence and they've given me money.
So therefore,
I like
The loaded question. Did you take me down the path or something?
the person who for a company who says I want to, I'm looking for $24 million, there's strategy to break that down and to say, for my first round, what do I need that I know I can meet, I can
Right.
perform well with.
Absolutely.
Maybe it's just that 500,000 at that first level. I know I can, with that, I know I can hit these milestones, because that will, and save the big ask for later after you've.
Exactly.
Does that make sense, what I'm saying?
Absolutely.
Absolutely.
Okay.
Yeah.
Okay.
And as a matter of fact, there's some incubators and things like that that have a capital arm to it.
Yep.
So you get to say, this incubator accepted me, which is already a way to say I've been picked amongst a whole peer group, and they've given me capital, and I successfully accomplished the milestones we set for that. So you can have a whole list of these types of things as you go forward for that next round, whatever that is.
Excellent.
That's one of the things I like to, again, with clients, let's work with our milestones. And let's even attempt to set them up where there is a monthly, if we're working on the 12 to 18 month period of time, let's have 12 to 18 milestones.
Right.
So every month you're doing the press release, you're
Yeah.
touting
Yes.
that we reached this milestone, then the next one, then the next one.
Exactly.
But that's what, and so Pierre, thank you, because you brought up the point, and that's what I wanted to say before, is investors like to invest in businesses other investors have invested in.
Exactly.
They feel due diligence has been done, there's some vetting that has been done, and if you live up to what you said you were going to do, and you treated your investors right,
Exactly.
so that's your investor relations, that's what opens up more than likely your early stage investors doing another round, but new investors then coming in.
Absolutely.
Now, I don't want to speak for you,
No,
but
no, you're absolutely on point there, because it is a network, and it's a small network when you really look at it, because several people I've seen pitch in one angel group. When I go visit another angel group, they're there as well. They're doing all types of pitch offs and things like that. So you will have a small network, and there will be people who, hey, I did this, and refer it to other investors. Or if it's not the space I'm in, I saw the pitch, I like the company, but it's not something I invest in. We'll go to here's some resources I know that work in that area. And when we talked about again going for that second round and things like that, I use it personally as one of the vetting criteria. Who else is invested?
Right.
And again, going forward, now this is the part where it gets a little difficult, right? So now if I've already invested in you and we've done a round and we're looking at a second round, now as an investor, I'm part of your team. So I'm looking out after you now because we are the same.
Right.
And so I'm looking to make sure whatever risk I took and you took in the beginning is protected. And the next round of folks who are now at less risk, then, because they're coming down later. We've already proven whatever milestones we set up. We want to make sure the valuation goes up so that they're paying more to represent the less risk they're taking coming in at that point. They didn't take the risk I did, or you starting the company.
And that is illustrated so well in the cap table.
Absolutely.
See how we're bringing that back? That is illustrated so well in that round 2 column, where you can see, okay, our new pre-money value is X, and our new post-money value is X.
Got all the terms down. You did a good job.
Let me tell you, okay, 2 weeks ago, I would have no idea what we were talking about, all right? So I am so grateful. Oh, here I go. I'm so grateful for you, Lorette, and for this program. It's fantastic. But yeah, like I can see now, visually, any new investor that's coming in at round 2, they are paying more for less less risk, and that's the way that it should be, because we've met these milestones, and our pre-money value at this stage now is higher.
Exactly. Now, sometimes I use Shark Tank a lot because a lot of people watch it, but you'll hear in a lot of cases where the sharks try to get them to give them the same terms as the previous investor, even though they're coming in later. I'm a shark. I'm so worth so much. I can get the some everybody else got, and they sometimes do, because it's all market value. How much is a shark worth? And but normally on a regular course, there is some premium that the next round and the future rounds will pay because of the lack of risk.
Right.
And if you set things out the right way from the beginning, it is work, but you want to ensure that you're not putting yourself in the position to have the down rounds.
Right.
you
Right.
know. But a lot of times that's the sheer nature of making sure that you set things out the right way in the beginning and you make the right kind of deals in the beginning, so you're less likely to have that.
Right. So the ideal cap table, and again, you guys have covered it already, but again, going forward, it's already divided everything up. You know, here's the stuff we're going to save for employees and consultants and, you know, the original founders, and here's what's going to go for round 1, 2, and 3. So you kind of have an idea of what that dilution is going to look like going forward before you get there. So as you enter each round, you know we have this number of shares that are going to go for, you know, these rounds. But you might not have the valuation at that point because it may vary, but you'll at least know how much you're willing to give up at point for additional investors.
Right. I have another question. I don't know if
Yes,
we're okay on
please.
time.
We're going to start winding down,
Okay.
but please.
My next question is about how you determine or what you look at as you determine pre-money value. I don't know if that's going into valuation, if you want to
That's
say
okay.
that, but
You'll
like
come back next time.
what factors do you look at when you're sort of using subjective reasoning to help determine pre-money value?
It's
There's
very
nothing subjective in investing, but
yeah, it's all quantifiable. I'll show you the algorithm. I have it on my phone. That's a tough question, and the real answer is whatever the market will bear, like anything else. And I'll give you an example. So we had an opportunity. We, meaning a group of investors, we had a presentation from a company, and they said our current pre-market value is $6 million, and that's this round, and they were trying to raise $1 million. And amongst the investors that I was working with, we had put together about 400,000. So we figured we're going to be the big dog in this round, you know. And we said, no, it's not worth $6 million, it's worth $4 million. His previous investor was also $1 million round, but it was one investor. So yeah, one investor with $1 million. So there was really no value. He was trying to establish how much his premium was going to be from his million to the second million. So he's clearly saying, you know, we're gonna bump this up a little. And we said, nope, 4 million we think is the right valuation. Unfortunately, they went to another angel group, and that angel group bought into the $6 million valuation, and they had $500,000. So, right, and we had to follow them. So we had to, that was the market. You know, so they at least convinced somebody else they were worth $6 million, and it prevailed. And we still made the investment, but you know, so we just got to make sure the next guys that come in at 10, 15, or 20 million. So that's an example of, it's hard to really say, but ultimately the market is, and you gave an example before of someone who for 7 years tried to raise money. Well, in your first 7 months of raising money, you're going to get an idea where people are. And you're going to have to determine, this is the range, but this is the range of real money I can get and the real valuations, and that's what I have to deal with.
And that is one of the answers that I give when people want to understand the value. And again, me coming from the investment banking mindset, I tell them in a minute, it's arbitrary. Because it's a negotiation between the investor and the entrepreneur. So both sides look at what they believe the numbers are out there, but until there's that discussion, really don't know where it's going to land.
But we always do have, as an entrepreneur, we always have a much more inflated view of what the value of our company is. As you should. You know, you should be behind it, and you should believe all positive things about it. But
and the angels will always have less. And then wherever you meet in between.
Cool.
So guys, as we start to wind this down, any last questions you might want to ask or comments you might want to make, Hilton?
Yeah, despite the extra effort we talk about that it takes to do cap tables right and things like that, it's worth the effort to do it right. It's worth the effort to get the training. It's worth the effort to use legal help where you can to make sure that doesn't, you know, cause some problem down the road, which it can very easily cause problems down the road. So make the investment early. You should be making it as you start thinking you're going to even go for money from anybody other than your friends and family. And smart friends and family might even ask you to look at the cap table, but they don't understand those terms either. But anybody going forward, you will, so you might as well invest in it early and understand it fully.
Excellent.
Great. Any last comments or words from you, Pierre?
Yeah, I would say just as an entrepreneur, this knowledge is empowering. It's empowering to sit here and dialogue with you and to be trained by you, Lorette. And I think if you're an entrepreneur and you're out there watching and listening to this, this is something you should seek and say, at the end of the day, I'm winning and my business is winning. And I shouldn't be afraid of learning the language of investment. I was going to say language of money, but the language of investing. It's okay. It is accessible. It can be accessible with the right training. So I'm grateful for it. Yeah.
Thank you. And thank you all for joining us on this segment of Capital Academy. If you like what you heard and want to plug in, please do. You'll hear the announcements that help you to understand how to do that. And equally, if you know someone that this information could make a difference for, please share it so that they can get the information and also plug in. But for today's episode of Capital Academy, we thank you for joining us and look forward to seeing you again.